and
This meeting is
the
being
meeting
recorded.
of the pension board on Wednesday, February 8th, 2023, and seek approval of the minutes from January 11th meeting. I looked them over. I didn't, go ahead.
I'll make a motion to approve.
Is there a
Second.
second? All in favor? Aye.
Aye.
Approved unanimous. Next is public comments. Are there any public comments? Not, we're going to move on to approval of the pension applications. Jerry, you up there?
Yes, I am. Can you hear me?
Yes, we can.
Okay. We have two applications for this evening. The first one is Michael Yosak, a principal engineer with the Economic and Community Development. He's elected option 1, and his will be an early retirement. The second one is Clarabelle Fontaine Torres, special ed aide with the Board of Education. She is electing option 3, and hers is also an early retirement.
Is there any discussion on the two pensions? I looked them over. I didn't see anything.
No, I didn't see any problems, so I move we approve both.
Excellent. Is there a second to that?
I'll second that.
All in favor?
Aye.
Opposed? No. Passes unanimous. Perfect. After that, ABS presentation.
Great. Frank, maybe I'll just kick it off. Eileen, before we start, do you mind just going on mute? Hear some background noise.
Okay, I'll go on mute. I can't seem to get my camera to work though.
Okay.
Okay.
So pleased to be joined by Tommy Kelly and Lawrence Russian from ABS to do a portfolio review. As you all know, ABS is one of your global equity long-short managers. They've been in the portfolio for quite a long time, I think dating back to 2007. So a long-standing manager with the city of Norwalk. Happy to answer any questions, and if not, I'll turn it over to Lawrence and Tommy.
Just before you do, you might want to introduce us to Kevin.
Sure, I'm happy to. So we were going to wait until after ABS's presentation to make the intro, but Kevin Schmidt joined Cowen in January, and he's going to be a part of the team going forward. I know hopefully you saw my email this morning with his bio, and it'll be a great addition. Kevin, if you want to introduce yourself now or after the presentation, please feel free.
Yeah, through the chair, I'm happy to wait till after ABS, or if you want me to maybe just make a couple of brief remarks now, it's up to you.
After ABS is perfect.
Okay.
Thank you.
Great. Tommy and Lawrence, over to you.
Fantastic. No, well, Britt, thank you for having us in today. Would you like me to share my screen, or does everybody have the presentation in front of them?
I have it, the presentation, but if anybody else on the
I
pension
have it.
board,
Yeah, I think we're all good. I think we've got it.
Okay. Yeah, fantastic. Yeah, so before we start, my name is Tommy Kelly. Been with the firm now for a little over 3 years, working on our business development team. With me is Lawrence Russian, who is one of the co-founders of the firm and our portfolio manager for our global strategies. I'll turn over to Lawrence to kind of run through kind of a brief overview of, and I guess recap of last year, kind of both on a personnel level at the firm, kind of talking about new strategies that we launched, obviously assets, and then I'll run through kind of a quick overview of the firm before turning it back to Lawrence to again talk through what has transpired over the last few years in the equity markets, how our strategy is done, and then kind of give you a brief overview as to where we think the markets are going, in the future.
one thing is we don't really need too much. We believe that your firm has hired excellent people, et cetera, et cetera. So you can just move into performance in the fund, et cetera. That's okay with you.
Yeah, fantastic. Lawrence, do you want to begin then?
Yeah. Tommy, do you want to pull, does it make sense to pull up the presentation? Because we're going to flip through a handful of slides with graphs and just kind of, it might be helpful to make sure we're all on the same page. Again, we can do it with or without it, but if you want to skip the firm, the high level firm stuff, we can skip. The 2 or 3 key points I would just simply make is, we continue to invest in the business. We continue to hire in all areas of this business. We 100% believe in the firm. We continue to expand the partnership. Tommy is one of the new partners made this year, which, we're very proud of Tommy and everything he's done. And we are going 100% and continuing to build this boutique focused on active management within the equity universe. So with that, let's turn to maybe slide 9. And Frank, you mentioned just to dive into sort of the performance in the portfolio. We'll set the stage a little bit, I think, in terms of the big picture environment, which I think most people are aware of, but it frames a little bit of what we're going to talk about. On slide 9, I think it's all, pretty clear that, what has been a 40-year bull market in bonds has probably, come to a close. That's had a lot of, ramifications on equity markets over the last 4 decades. Maybe more important than that is on slide 10, where over the past decade, we've just seen unprecedented levels of stimulus, money printing, and this money finding its way into the system, which ultimately finds its way into risk assets, driving equities and specifically U.S. equities higher, sort of year after year over this past decade. The other thing we saw specifically within equity markets was, again, a lot of this money finding its way into the cheapest, easiest, sort of simplest forms. And so what you see on slide 11 is that the flows into equity markets were predominantly into passive equity funds, index funds, ETFs, et cetera. And over the last decade, we've actually seen pretty steady outflows on the active side. In an environment like this where indices dominate and they drive price action and sort of risk assets are just being pushed higher, and speculative natures are pretty rampant, made it tough for active management in general, which is shown on the right-hand side of the page, where you have active U.S. managers who had historically generated, give or take 300 basis points of excess return over their respective indices. This is a broad snapshot coming from eVestment relative to this past decade, which I'll just call the decade of money printing and zero interest rates, where that alpha was, considerably compressed. So I think that sets the stage for what we've kind of lived through in terms of active management. And on slide 12, there's 4 different graphs, but I think the simple summary is that's all changed. Inflation is back in the system. Interest rates are normalizing, as painful as a process as it may be, probably a healthy normalization. Capital markets are going to have to rationalize. Companies just can't continue to issue equity with no, consequence and no ramification. Companies' ability to just roll debt at low rates, regardless of credit, status. I think that's all sort of come to an end, and we're entering sort of the new paradigm, or I would say actually back to a normal paradigm of equity investing. So specific to 2022, obviously inflation dominated the overall picture. This is on slide 13. This is just the Fed dot plot you see on the bottom right, where the expectations were at the end of 21 versus the end of 22. Obviously, dramatic changes over the course of the year, caught most people by surprise. And again, that was the #1 trend for equity markets over the course of the year. You see that on slide 14, where there is an almost, perfect correlation or inverse correlation, depending if you're looking at price or yields of the 10-year relative to broad equity markets.
What do you think of the dot plan? Do you agree with it, or do you think that, the market doesn't think that the Fed is going to be, above 4% at the end of 24. What do you guys think?
We build pretty balanced portfolios to sort of try to weather any outcome. But I'm probably more in the nature of inflation is going to be a little stickier than people think. The Fed is not going to go back to the way they behaved for the previous 10 years. We've lived through a decade of excess everything, and we kind of need to take our medicine and get back to what I'll call a normal, rational environment.
Do you have a view on what you think, how the S&P will end the year?
I really don't. I think there's gonna be a lot of volatility. I think we're gonna see periods like January, and frankly, like we've seen so far this year, where people's views change on a couple of numbers that get printed, and then we're off to the races for short periods of time in the most speculative parts of the market. But I don't think we're through this. And so if you told me the S&P would be plus or minus 5 from where we started the year, with a lot of volatility in between, wouldn't surprise me a bit. And I think actually, for us, more important than the market level itself is I think we're going to, I think a lot of valuations have reset. They were out of whack. We're not low by any standard, by any normal historical measure. But, there has been a hard reset in a lot of areas. And I think, earnings should matter going forward, and that should have more of an impact than anything else, assuming rates stay within some relevant band of 100 basis points or 2 either way.
You said plus or minus 5 wouldn't surprise you. What would?
Plus 20.
Minus 20? Plus or minus
no,
20?
minus 20 wouldn't. No,
Okay.
I wouldn't.
You're asymmetric to the downside then.
Yeah, I think so. I think it's almost like human nature just tells me we've lived through such excesses. The hangover is not going to pass this quickly. But I think we could be due for some real volatility along the way. And I know that everybody looks at calendar years, but I don't know how it's going to shake out. But I feel like there's more pockets of excess that need to be wrung out. And some stocks are going to be good buys from here, and others definitely will not.
Do you think there's as much excess as there was in 07, 08?
I think so. When I think about like technology stocks, right, which is obviously where a lot of this stuff culminates. We have looked, and we actually have a slide on this toward one of the last slides. But we look at sort of the, what happened to different parts of tech, whether it's unprofitable or profitable or unprofitable that became profitable, where we came in 2020, the short peak, and then, stocks that were down 50 to 90%. There are a lot of stocks in the US down, 50 to 90%. So, I think some are going to recover that are real businesses that can turn profits, and some just never will. And you're going to have companies that people believe are going to be more resilient and that return profitable that it won't. And so I think you do have more downside in a lot of pockets of the tech space.
Thanks.
Yeah. So turning maybe to 15, just in terms of, again, this is broad market, but then we'll get into the portfolio because, again, I know a lot of this stuff is kind of general. But, not surprising in a year that we just, discussed for 2022. The growth areas got hit the hardest, as would be, expected, with most of the, terminal value equating the valuation of these longer term growth stocks. Value cyclicals had, a fair amount of volatility, but held up, generally fine. And defensives held up relatively well, aside from real estate. Energy was the one, large outperformer, if you will. Not surprising given the how underrepresented it became, both in the indices as well as in active management in general, right? Energy had everything going against it. Traditional dirty energy had everything going against it for quite some time. And so we've obviously seen a reversal of that. Slide 16, this is the last slide on kind of general market stuff. But it is interesting, to highlight, and we put it in here because different people have asked sort of what's been the, what's made the long short returns underwhelming. I don't think they're terrible, but they have been underwhelming. And the downside protection has been fine. It's been some of the snap rallies to the upside that we just haven't captured, or the industry in general hasn't captured. And I think that goes, Richard, to what when you're asking about where we are sort of relative to 98, 99, et cetera, is that I think there's a lot of folks that don't believe this is over yet. And so they've taken down the levels of risk to kind of weather what they think will be a continued storm for the foreseeable future, and sort of waiting for the opportunities to really get more aggressive on the long side again.
What do you think nets are running?
So, I mean, our nets are running, high 30s, low 40s.
What's typical for you?
Mid 40s. So we're
So
not.
you really haven't cut back all that much.
No, I mean, we have not seen dramatic shifts in the net. What we've actually seen is an overall decrease in the gross exposure. And that's because people generally think in an elevated risk world, you don't need as much overall exposure on as you do in a more stable world. So if you leave the same level of total gross, risk on, but the market risk doubles, well, then you've just increased your risk in a
Oh,
considerable.
yeah. I
So
know
it's
that
kind of like-
story.
Yeah, so people are basically, counterbalancing the volatility they expect in the markets with their overall exposure, which, by the way, we fully support. I mean, that's what we would expect.
What do you see as cash levels? Or just,
Um,
they're just running lower leverage?
Yeah, it's lower leverage, and long short comes in all different shapes and sizes. We've never been big advocates of people that run real leverage, what I call 150 long, 100 short, 50 net, where you have a 250 gross. There are people that do that well, but when it goes wrong, it usually goes terribly wrong. Our standard template, for a fundamental stock picker, specialist within a given sector or region is usually about 100 long, 50 short, 50 net. So they're really not taking, financial leverage, from a bank or, their prime broker.
Okay, thanks.
Yeah. And again, that's just a style preference. It's not good or bad. I just think we're a little bit more on the conservative side with that. So if we hop into slide 18, here are the numbers. The 1-year number for 2022 was down 8.5 relative to the broad, global market down 16. That's again, underwhelming performance. It's fine. From everyone we've spoken to, we've actually been doing relatively well compared to our peers. I think a lot of people saw a lot more downside in 2022. And obviously just comparing our broad numbers to the market looks great. 8.5 versus 16, but again, we would always hope to do, a little bit better that on an alpha perspective. Turning to slide 19, this just puts a little bit more perspective, I think, on what has worked and what not has worked, it hasn't worked for the past decade. And it frames a little bit of how we'll kind of wind up towards the end of the discussion of what to expect going forward. Our view is that, the long stock picking historically has driven, a fair amount of alpha over rolling, 2-3 year periods in the active equity space, what we consider, the long short space. And 3% is probably a pretty good bogey for that. I think we vastly outperformed in 2020. We underperformed in sort of back half of 2020, underperformed in back half of 21, 22. And I almost take that and put it aside and say, I think we saw a blow off top in 2020, which, took a lot of stocks to excesses they shouldn't have been. And we've now seen the kind of reset to where we are today. I would hope in a more normalized environment, we can go back to generating that sort of 3% type of alpha on the long side. The short side we've struggled with for a decade, really since quantitative easing started, in full force. It was particularly difficult in 2020, which is obviously the mirror image of the long side. It's worked in the last 18 months, but it's really worked just because of some of the just ridiculous, speculative excesses that we saw in pockets of the market. Again, I think if the broad brush that's been kind of squeezed out of the market, there's certainly still opportunities on a stock by stock basis, but I don't expect that sort of dramatic, those dramatic moves wholesale on the short side. But what has changed on the short side, and we do have a slide in this I'll get to later, but it's extremely important, is, you know, in a period with zero interest rates or near zero interest rates, there's no short interest rebate. So one of the positives of shorting stock is when you short a stock, you borrow the stock, you sell it into the market, you get paid the cash for selling into the market. That goes into your prime brokerage account, and you typically get Fed funds minus 0.5. It's 0.25, it's 0.5, it varies depending on negotiation. But so for 10 years, people came in and they didn't have any short interest rebate, and it was tough to short stocks, you know, in a stimulating tape. Today, the stimulus is gone. We're actually taking, you know, the opposite side of that in terms of, you know, government, you know, monetary tightening, and you now have a 3+% short interest rebate. So I think the short side also comes back into the future to being a profit center instead of a drag going forward. Turning to slide 20, and I am going to try to be cognizant of the time, so please, you know, give me the heads up if I'm being too wordy or you know, spending too much time in any given area. But if you turn to slide 20, this is just more details. I think you asked on, you know, performance details. This is what helped. This is what hurt. The lighter blue parts of these bars on slide 20 is what we call the alpha, the excess return over and above the risk levels taken. And as I've already mentioned, but this kind of like lays it out, the places that managers attracted value was really technology, media, telecom, some quality growth in the US, and a slight growth bias in Asia. And again, I think that excess has been wrung out. Areas we did generate alpha was healthcare, small cap, Latin America, some commodity related stuff, although it was really not hard like dirty commodities. It was actually more in the clean energy space, as well as real estate and financials. But that's a very broad brush of where, you know, when we look at the underlying areas where we did well, where we didn't. The other way to look at the portfolio and the performance in 2022 is laid out on slide 21. These are the top 10 managers in the portfolio, which typically, you know, we call it like the core, the ballast part of the portfolio, which usually comprises about 50% of the total investments. In this case, on the average, it was 48 on the year, so very much in line. And the average return, the weighted average return of the top positions was just under a -1%. So the diversification, the ballasts, the different types of strategies we have in place that we call kind of the all-weather component of the portfolio did its job. And there was a few outliers that were disappointing, but overall as a group, they did well. And it was really the smaller satellite positions in the higher risk areas, predominantly in growth in TMT that underperformed. And they didn't just underperform because the market went down, they underperformed because of stock picking and the market going down. So I said that's where the sort of the negative alpha came from over the course of 2022.
So a couple of these guys, you know, were pretty bad, -26%, -23%. What's the turnover, or what is, do you, first of all, that's 10, and that's roughly 50% of the money. How many managers do you have? And then what are your, what's the criteria for, you know, ending their relationship with you?
So typically we have 26, 28 managers. And again, top 10 are usually 50% of the portfolio, give or take 5%. Turnover runs between 15 and 20% a year. It's been pretty steady. It's no higher this year than other years. And the evaluation for firing a manager is more qualitative than quantitative. Now, if they completely blow through every risk metric and like that we could ever imagine, that's a different story. But, you know, if you look at those numbers on slide 21, 101 stands out. You just mentioned this is down 26%. We did actually redeem from 101 at the end of this year. It was not because Sam was down 26% in the year. It's because he ended up over trading and moving his portfolio around throughout the course of the year, combined with the fact that about mid-year, he became convinced that China was going to invade Taiwan. and it was going to happen fairly imminently. Now, he grew up in China. He went to school with a lot of folks that are pretty well connected. So he has, there's a reason he has developed this view, but it impacted everything that he did in the portfolio. And at the end of the day, we said, Sam, we're not making a bet on that. We're not saying it's not going to happen. It'll be catastrophic if it happens, by the way. It's going to affect global markets like we haven't seen in a very long time. But we didn't hire you to make one macro bet and to build your portfolio around that. So we did exit at the end of the year, which we don't love to do after people have tough years, because generally speaking, when somebody does poorly for a year, if you can identify why they've done poorly, it's better to stay with them over time. They're going to recoup that kind of underperformance.
How long has he been with you? And what is his performance in the past?
Yeah, it's been good in the past. So he's generated pretty consistent alpha. We had been with him probably 3+ years coming into this year. He's someone who can move between predominantly China in the US, but he does a little bit in Europe, but he just his macro view overwhelmed. And when a singular macro view overwhelms a stock picker, it doesn't end well. And they usually never get back on track after 25 years of doing this. It's a different skill set.
I mean, I don't know for sure, but I think if China invaded Taiwan, we would discover exactly where the halts are in the stock market.
Yeah.
But that's just, and what about this other guy, Antero Peak? He's
Yeah.
down almost 24%. That's,
Yeah, so Antero Peak is very long biased in a lot of the US kind of mid to large cap stocks. And what happened in the US in the first half of the year, and specifically in Q1, was any kind of like quality growth stocks got hammered. And that's a pocket of the market that he has been involved in the past, still involved with, and so he underperformed what we would have expected. Disappointing, not outside of the realm of possibility, not outside of our scenario analysis. So we have stuck with that manager.
I mean, maybe I have the numbers wrong, but I would think that if he was 100% long the S&P, he would have outperformed, and he's supposed to be a long short fund, and the market was down. So he's down. So he should say he's going to be long, like as you said, 50%, maybe long, maybe more aggressive hedge funds have a negative stock position. But he's down 24% in a market down 18, and he's supposed to be partially short. That looks like he did work hard. It just didn't work well. But
no, I would argue, yes, he worked hard, but it obviously did not work. He runs in the 70s net long, as opposed to the 50s like some others. So he has historically played a role of adding a similar amount of alpha on the upside relative to broad US markets. And this year it was the mirror image of that. And so the decision we have is, okay, if he's had a number of good years where he has generated 600-700 basis points of alpha, and this year he detracts that, is it the time this time to sell him? And actually we're going to see him again in 2 weeks to spend some time with him, face to face. And we'll evaluate whether we'll think he gets back on track, or if he doesn't. And if we don't think he's going to get back on track, then we'll exit. But we don't often do sort of, I don't want to say like knee-jerk reaction, but it's we're not often saying, let's just, they did poorly this year, let's fire him, because my fear is you end up chasing your tail a little bit on that. And by the way, we've experienced both. So been doing this a very long time.
Well, wasn't growth TMT overall down 20%? So, I mean, it's, is that a fair comparison for what you have on slide 20?
On slide 20.
Yeah.
Well, no, sorry, that was 20% of the that's 20% of the average. That was the average allocation for the year. So the 20% number below TMT, is the average allocation, and then the actual impact on returns, the contribution to returns is that sort of +2 to -6 on the left-hand side of the slide.
Okay. Thanks.
But the actual, to answer your question, Frank, the ins and outs are actually on the next page on 22. And so there were, there were 3 managers we did fire. Stackline was the first one, and that was, they didn't do a terrible job, but they just haven't gotten traction. They haven't added the alpha that we expected they should over the last couple of years. And it became a fill or kill decision for us, meaning, after a few years, we're either going to size them up or we're going to take them out. We didn't have the conviction to size it up. They came out. 101, I just described, one singular macro view drove everything. He just, going forward. So we can't be there for that. And lastly, Altimeter is somebody that we exited from the TMT growth space. That's somebody who we had in there partially because he has a good balance of stock picking. He has historically had a high level of concentration, which we're comfortable with, but he has been sort of macro aware. He was talking about, valuations being stretched. He was talking about interest rates needing, inflation coming into the system, interest rates going higher. And he just had the most awful execution possible. And so one of the reasons we stuck with him coming into 2022 is because we thought he actually had a good view on what could happen in the growth space. But he just misexecuted and did a poor job. And ultimately, it was an undersized position and we decided to exit. So there are going to be cases where people do poorly. We stick with them. There's going to be cases where we don't.
I got a sense from you that you were like, when Rich asked you about what could be an outlier and you said up 20%, but down 20% might not be. But yet the new managers are all long bias.
Yeah. So just to take a step back, to be very clear. So our guidelines for this portfolio are to try to run between 30 and 60% net long global markets, right? The midpoint is 45. If we're within that, we typically don't take any sort of top-down macro, action. If we start to get to below 30, we're probably going to start to increase the long bias folks. If we get to above 60, we're going to start to slice them back. So we don't have a skill set to make a macro call. I just, when asked, I'm giving my honest opinion, but it really doesn't impact the portfolio in any substantial way. These were just the additions were folks that we have come across, many of whom we've been doing work on for a while. And we just had conviction that they're going to navigate the space. And more importantly, they're going to generate alpha above and beyond the risk levels they take, which at the end of the day is what we have to do to perform. So with that, I know that, again, I would need to respect your time. Let's, if you want, we can just hop into how we're positioned, just going forward. And again, just at a very high level. As I said, net exposure, which is here on slide 24. As I mentioned, we've been kind of the, high 30s. Right now, we're 39%. The average over the course of last year was 42, which again, all is within our normal range. If you turn to slide 25, that just shows you how we're positioned. The global portfolio in dark blue today relative to 45% of the MSCI all country. It's relatively in line. The one area that we will always be overweight relative to the index is going to be small and mid versus large, and that's just because of the nature of a cap-weighted index. Otherwise, the slight overweights and underweights that will move around both sectorally and regionally just happen over the course of it changes over the years. We don't try to take a bet to say we want to be overweight, energy versus financials or vice versa. Again, we want to find talented people that we think can outperform in every given space and kind of let them generate the excess return. Slide 26 is just another way to look at how we're positioned coming into the year in terms of different types of sector specialists and country regional specialists. And again, the top 10 weightings in the portfolio. We have some generalists, but it's the minority of investments. We really are trying to find people within a given vertical or segment of the market that we think can outperform. And maybe lastly to end, because I know I think this was supposed to be 30 minutes, and I know we're running a little bit tight on that. I'll fly through these next couple slides. But on slide 28, I mean, we're trying to look at the math of what's worked and hasn't worked in long short over the last couple of decades. The short answer is on 28 is that when the Fed funds rate was below 3%, broad markets, S&P did quite well. Long short generated about its beta, not much alpha, which is obviously not ideal. In periods where rates were higher than 3%, markets, didn't do quite as well, and long short actually did do well, partially again, as I mentioned, because of the short side. Looking at this in a different way is on slide 29, where we just break out broad decades. We look at 2000 to 2009 was kind of a lost decade for global markets. Really wasn't any return. It was like 0.4 annualized. But long short came through with a fair amount of alpha, both long and short, generating a decent return. The past decade, again, the decade I'll call the decade of stimulus and monetary easing. Stock markets did quite well. Long short struggled. It again about equaled its beta, a little bit of alpha on top. Put the 2 decades together, and you end up with a pretty good overall return, slightly better than the market, and certainly better on a risk-adjusted basis. One of the questions which we've been asked recently, I'm sure you guys are asking yourselves as well, is on slide 30. That's what should people expect from long short going forward? And I think it's a very fair, it's a very fair question, and it's something we spend a lot of time on. So we laid out one scenario on slide 30, and that is we chose 15% up market and down market, not because we expect that to be the case in any given year. But while most people, and I don't know exactly what Callan has for capital market assumptions, but most people have, high single digits, long-term sort of equity returns. That said, about 50% of the time, the market is either up 15 or down 15. So that's quite common. So our view is with equity long short, the way we manage it is we typically have about half the beta of the market. So in an up 15, we should get 7.5 just from beta. In a normal environment, we should get back to generating 300 basis points of alpha. That gives you 10.5% type of return, which is about 70% of the upside. On the reverse, market's down 15%. We should probably lose about 7.5 just from the beta we have in the portfolio. If we can generate 300 basis points of alpha, that brings you down to 4.5%, which is about 30% downside. That's not been the case lately with the market environment we've been in, but that is our base case going forward and the expectation we have.
Lawrence, what has been the reality of the portfolio's performance in terms of, markets up 15+%, markets down 15%?
It has really varied year to year on what's driven markets in different periods of time. I used to broadly say 2/3, 1/3. If we can capture 2/3 upside, 1/3 downside, I think over time, you're going to end up with similar, if not better returns with half the risk, which is exactly what we should be trying to do. And I just, as I pointed out, I think the last decade of monetary, stimulus and money printing and short rates at 0, so no short rebate, has created an environment where it's been very difficult. And the alpha hasn't been there. So the beta, very candidly, the beta you shouldn't pay for, right? The beta is just, you don't need to pay for beta. So the reality is we need to be generating these 2, 3, 4% alpha numbers on top to make the math work. And we did it in different type of environments. It's been a struggle lately, and I believe we're going back to it. And as I said, and maybe let's flip to actually 31 just real quick, because I can't emphasize enough, when one side of the portfolio is not generating alpha, and has a negative short interest rebate, that's a big headwind to generating excess returns. And that's what we lived through for a decade. Coming into 2023, the short interest rebate on average was about 3.9%. And I think the alpha generally from stock picking on the short side should come back without sort of the speculative excesses driving markets higher. So part of the issue has been the short side, and I would argue that the setup going forward should be far better than it's been for the last 10 years.
You know, I was looking at some numbers here. So from January of 2017 to today, that's 5 years, market's up 80%, 86% roughly, the S&P. And if you were 50% long, for simplicity, you'd be up 40%. And you're up 3% a year. That's 15% versus 40%. And right now, the 5 year, which I don't even, if you ever talk to Britt, he'll tell you I don't like bonds, but the 5 year bond is paying 3.81%. And over those 5 years, you guys returned 3.07. So in a massively bull market where, you know, long short is still, you know, a friend of mine runs a fund and he says, well, a long fund, you know, long short fund is really just long light, meaning they're not, you know, they're not 100% long. So it seems that, you know, as a layman, I wonder why, how do you justify that type of performance if you're long 50% net over a 5 year period when the market went from 2,200 to 4,100?
Is that
Yeah, I mean-
comparison versus, I'm sorry, was that comparison versus the S&P or versus the MCI world?
That's against the S&P, but I always like the S&P.
Yeah,
Yeah.
but
Yeah, you're right. I apologize, and I don't have the MCI up here, but I think if we look, I think the MCI was
Yeah,
the MCI was up 5% over 5 years, was up 6.14, and they were up 3.3. You know,
That you-
3.7. So
Frank,
that's 300 basis points under. That's not adding alpha. That's
that's
you know,
what that effectively is so again, you know, as I said, sort of 30 to 60 is the range, 45 is the midpoint. If we delivered 45% of the MSCI over that last 5 year period that you just said, we should have been up 3.1, and we were up 3. And so in my view, that's why I said there's been no alpha in this most recent environment. That said, we've been doing this for a very long time. I think in a more normal environment, there is alpha, and it comes from both sides of the portfolio. That's what I believe we're going to get back to. If we don't get back to it, then, you know, there's a problem. There's probably a problem for active management in general, would be my guess.
when do you think that will be obvious? Do you think that's going to be in another 18 months, 2 years, 3 years? What's your sense that when we'll be able to know whether it's coming back or not?
I think again, on the short side, the short rebate is already there. And so there's a little bit of more wind. There's wind at the back instead of wind at the face, which is good. I think it really depends on how volatile this market is this year. If it settles down a little bit and earnings start to matter as we get into earnings seasons, I think you could see it. You could see it unfold this year. If we see violent moves up and down, I think it's going to be a lot harder in the short term to see the differentiation.
Do you think there's been an erosion of short stock picking skill though over the
I do.
last 10 years? I mean,
You
does
know-
that, in one way that helps you in the fact that if you have someone that's a good stock picker, it's a lot easier for them, but you may just not be able to put enough money to work.
I do. I think it's harder than it used to be, for sure. And so, if we used to do, 3 or 4 points of alpha on top of on the short book, I don't think we get back to that. But can I see 1 to 2 points, plus the short interest rebate? I can't. And I think we do have people that generate alpha, you know, on the short side, but it's been a real struggle in this kind of, you know, equity market environment we've been through.
When you look at people, do you try to isolate their stock picking skills on the short side and also on the long side?
Absolutely. We measure, you know, before we enter a manager, we try to measure where is their value add come from? Does it come from top-down awareness and tilting the portfolio in different directions? Does it come from pure stock picking within a given sleeve or a given sector? And if that's the case, which is most common for us, does it come from long or short? And sometimes the answer is what really matters is the ratio between long and short, the relative performance between the two. Because you can have a year where, you know, you do great on the short side, but you do, you know, great one side or the other, right? The alpha comes from the spread between those two portfolios when you're running a sector book.
Yeah, generally people don't have enough shorts to offset bad longs.
Yeah, 2 to 1 usually in the way we look at it. Yes, the platforms are a little bit different, but yes, with traditional long bias, long short, it's usually 2 to 1.
Have you had redemptions or have you had increases in the size of the fund?
You know, we've seen some redemptions, but actually not very many, not very much. We had a few clients switch to a longer bias product that we have, and we had one client move to a effectively a beta 1 portfolio that runs sort of 80 to 100 net. And that client wanted more beta, they wanted more risk, but they believe active management is going to make a comeback. They believe in what we do. And so they moved their money into something which runs 80 to 100 net long.
But of this fund, is it larger or smaller than it was, say, 2 years ago?
2 years ago, it would be smaller, partially because of performance. Probably more, I mean, performance has had a bigger impact in both, you know, like a 2020 and a 2022 year than the actual flows. And we keep a very liquid portfolio, just for whatever that's worth. We're not, you know, we offer quarterly liquidity and we always have, and we've always stuck by it.
Does anybody have any other questions? Am I going to be the only one who beats them up?
I thought
You've done a
pretty
good job.
balanced,
Yep.
Frank.
I appreciate that, Rich, believe me.
I mean, what I find you're really interesting in what you said, Lawrence, is that and I appreciate the honesty here. You just don't know if the short side's going to come back to make this kind of product work. Is it going to generate, now that we're in a reasonable rebate period, are we going to get that alpha contribution or not? And you know, time will tell whether it's 18 months. I think 18 months, 2 years, we ought to know for sure.
Yeah, I would agree. And I would just make the point of, you know, and I do expect some alpha to come back. But even if alpha has stayed neutral, which is kind of what it's been, it hasn't been there. But you get paid a 3% short interest rebate on, again, remember, it's, you know, 100 long, 50 short. That's a 1.5% just, you know, waking up without doing anything. So I think there's going to be a little bit more wind at the back for these strategies than we've seen. And I think psychologically, it's good for people as well, for these folks.
We'll see.
Yeah.
Thank you very much.
Yeah.
Thank you.
Yeah,
Thank you.
thank you very much.
Appreciate the opportunity.
Thank you, guys.
Thanks.
And you, by the way, had to take all the questions and everything, and your buddy there just kind of sat there and smiled.
He was taking all the bullets for me.
Yeah,
That's for sure.
Thank
But no,
you.
yeah, thank you again. We greatly appreciate your business and working with you all, and you know, hope to continue that partnership as well. So thank you for your time.
thank you for coming in.
All right, thanks, guys.
Okay.
Thank you.
Bye-bye. Have a good evening.
Good evening. Brett, performance review?
Oh, are we gonna have a
Oh, you
follow-up
wanna-
on
yeah.
that?
Yeah, I was
No,
gonna
no, I
see if
think
there are any
I-
reactions.
I would like to have it, actually, I'm just afraid I was beating them up too
No,
much.
I think we give them the 18 months to 2 years to see if it seems like if they're not able to capture long short, then I don't know whether nobody will, but it certainly will answer the question in my mind as far as whether for a firm like us or for a fund like ours is do we give up too much upside return for not great downside capture? And if the short side of the book doesn't do better on downside capture, then why bother? Yes, you get hedge, you get lower risk, but I don't know if that gets us anywhere for the size, for the $20 million out of for the percentage allocation that we have.
Well, this, if you look at on the, Brit's report, S&P was down 18% the last 12 months. They were down 8.5%. So that's what you're buying, right?
Yep, absolutely.
Right, but over the last 7 years, they're up 3% and the S&P is up 11.
Yeah, but if you listen to what he was just saying, he's kind of writing off the past decade as abnormal.
Yeah, that's why I think we gotta,
Yeah,
if things will more reasonable monetary policy and more reasonable interest rates and a more reasonable cost of money, we ought to be able to tell in 18 months to 2 years whether in a what he characterizes as a more reasonable environment to see whether it happens or not.
yeah, I don't disagree with that. I mean, I'm not suggesting we take the money away. I'm not a big fan of long short to begin with. But at least if you can, a lot of times to me is in a bear market, what you capture is profits on your shorts, and not just 3.5% on your money.
Yeah, but long short worked pretty well in the 2000 era, right? It has been the last, whatever, 5, 6, 7, 8 years that it's kind of been in the doldrums. Does that sound right to you, Brett?
Yeah, and I think Lawrence detailed it pretty well. And I mean, the last 10 years, the stock market's gone straight up, growth tech has gone straight up. Central bank stimulus is really unprecedented. And to his point, I mean, stocks are going up, not necessarily because they have a great business and a great balance sheet and great cash flows and they're a great business, but it's been a lot of speculative nature, which is why we've seen such a big correction. So
too much money.
To his point, if fundamentals are rewarded, it shouldn't enhance their returns. But as we've seen, the volatility in these markets, fundamentals seems like they're starting to get rewarded, as we've seen value and higher quality companies certainly outperform the more speculative stocks in the last 6 months. But I think that's going to be a key driver.
I do think, though, that the long short funds are just out of vogue right now. I mean, I didn't try to nail them down exactly, how much they've lost in redemptions, but I'm not, like I said, it's not a large portion of the portfolio, and we might be in a period of where where the market's unchanged for the next 5 years.
So we penciled to have them come in the fall of 2024.
Well,
See how-
maybe you said I might give them a year, not a year and a half. because,
Well,
but, you know,
Well, let's see
let's see how they do, right?
how
yeah,
they do, and if we need to bring them back this fall, we can do that too.
you know, Charlie, what do you think?
I'm inclined to say give him some time. One question that wasn't answered, he's saying if interest rates go back to normal, which I think he's saying 3, 4, 5, 6%, what happens if they go up to 12%? And listening to what he said, that's a possibility. Listening to what the Fed's been saying, that's a possibility. Inflation is much more stubborn than a lot of the optimists are saying. What happens to his returns in a 12% interest environment? Brett, you got a speculation?
I think if interest rates go to 12%, we're in a lot of trouble.
Yeah. Yeah, I think there's gonna be new faces in this, like a Zoom.
Yeah. But
I mean,
no,
it's-
I'll be very honest. I'm not optimistic that that's not going to happen.
Yeah,
But
you
if
could
I-
well,
Yeah.
you could well be right, you know.
I would love to, as the newest guy in the room, I would love to maybe pose a question to you all, which is for my education, just to understand how the board is viewing this position within the construct of the entire portfolio, because I've heard it, everybody talk about protection on the downside in terms of the hedging and obviously lagging on the upside. What is the purpose? Is it to act as a hedge? Because if that's the case, then they did that last year, and they've maybe shown some merit there. But are we viewing them again more as a additive on the long side where they've been lacking, whether it's predicated on a particular market environment or not? And that might help to inform the group's view on whether or not they've held up their end of this deal.
I view long short primarily as something to reduce volatility, because they do have they do have a lower risk. But the question for me is always what do we pay for that lower risk, and whether it really doesn't make any difference given the what do we get for that risk reduction given the long-term nature of our liabilities. I mean, if it's
Yeah.
is our best way of meeting our liabilities is to have a higher equity allocation to generate those potential returns, or can we do it by having a slightly lower risk profile, which these types of investments bring us? The same thing is I see it a lot like fixed income, but maybe not as correlated with fixed income.
Yeah, I think that's a relevant perspective, that basically this fund is going to be around for whatever, 30 plus years. And then you can take a really long-term view and say, but don't worry about it. We can handle the ups and downs, and we'll come out fine. If we're heavy on the equity side, that probably works better if it's your own private portfolio and you don't have to worry about anyone looking over your shoulder. But that's not what we are. We're a public fund, pension fund, and people pay attention, I think, to our results. At least some people do. And so I think we do have to try and modulate things a little bit. Yeah, my view is I think we were all getting a little disenchanted with long short because of its lousy performance recently. But I think Lawrence did a pretty good job of, helping convince people that the last 10 years were an aberration, and hopefully we're looking at a new day here going forward, the next couple of years. So we'll see.
if you look at even, you take the last year, okay, now they've underperformed 3, 5, 7 years. So the last 12 months, 8.5% and 18. And I mean, just theoretically, if you said, okay, I'm gonna take 50% of my money and put it in an MCI World Index Fund. And then the other 50% put it into the 5-year paying almost 4%, 3.81%. So if you look at it, if you had the MCI index was down 18%, so you lost 9%, but and then you made up 4%, on your 5-year.
Yeah, but
So
you
you-
wouldn't, the 5-year was, when you made that
5 years
investment in
wasn't
the
at
index, the 5-year
4%.
wasn't
I mean,
4%. It was
Well, the
2 or
5-year
1.
actually, I mean, rates have been, moving up, but 3.8 is not even the high on the
Yeah.
5-year.
I know, but
The 5-year's been higher.
you're mixing a prior year return with a future return.
Well, I mean, they always say past performance is no indication, but we're looking at it and saying, hey, I mean, I'm just,
We'll see.
right. Think about this. If you look back 7 years, okay, and you bought, we can put up a chart here to make sure I don't, let's see, hold on.
Well, the MCSI was 4.5 and they were 3.3.
Right, so if we were 50%, right? If we were 50% in stocks, and it's 8.5, 7 years ago it was 8.5, and we just said, we're gonna take 50% of the MCI index fund, we would have made 4.25%. They made 3.3%. So we'd have picked up 100 basis points there. And I can look up in a minute here where the 5-year was. Let's see.
I think we would have had a loss in the 5-year.
Well, what I'm trying to say though is the 5-year or the 7-year, actually we're doing, because we look back 7 years. The 7-year was yielding 2%. That goes, oops, I'm sorry. That's incorrect. It was paying over 2.5%. So we would have been better off. That's all I'm saying. I mean, we would have gotten 2.5% of 50% of our money. So we picked up 100 plus basis points there. And the MCI, we would have picked up another 100 basis points on an MCI index. So it would have picked up 200 basis points over 7 years, right? That's 14% of $20 million.
See how that works on 5 years now. When
Well,
the
we do
index
it
was
for 5
1.5.
years.
I'm just
Well,
saying you're picking starting and ending points, which I think
Well,
is,
I'm not picking and starting ending points. It's the data that we got. We got the data 7 years ago, right? That's what I did.
but what if you would have looked 5 years back? You probably
Well,
get a different answer, right?
Yeah, it might be, yeah, I could have a different answer. It might even be worse. Who knows?
Yeah.
5 years, in fact, 5 years ago, in February, this goes back to February 2018, 5 years ago, the 5-year note was paying 2.67%. Okay, so it's even better than the 7-year actually. So it's 2.67. So it's
4 versus 3.
wait,
Yep,
So
4% versus 3.
7%. And then they for
They
their
did 3.
5 years, it's a wash. They had 307, they had 614. So it's 50% would have been exactly what they did. So we would have picked up 2.6% or 1.3%.
I don't think there's any argument with that, Frank. I mean, what I'm hanging my hat on is when we is with the environment, with the rate environment changing, do they start to go back to outperform? And if they, if they don't, then I think we're need to make a decision then. I don't know if we're at a decision point right now.
That's fine. I agree with you.
Mhm.
We'll look, say, a year from now and see what happens. That reasonable? Because if anything, the market's thinking rates might start back down in another year.
Yep.
I agree. Let's look at a year to 18 months.
Okay.
I'd say a year sounds good.
Okay.
All right. Anything else?
No.
Okay. Performance.
Great, thanks, Frank. Maybe this is a good opportunity for Kevin to introduce himself to the board. As I mentioned, Kevin joined in January and has a number of years of consulting experience and certainly has been in the industry for a long time. So Kevin, maybe you can introduce yourself for a few minutes.
Yeah, thanks, Britt. First of all, I appreciate everybody here allowing me to be a part of this group. Really looking forward to it. As Britt mentioned, I had a fair amount of time at actually a pretty direct competitor to Callan. I would say inferior, right? But I did work with a few public pensions over there. I worked at the state of New Jersey and two municipal plans for separate municipal plans for the city of Jacksonville down in Florida. So I'm excited to continue working with another public plan here at Callan. Prior to my time at the competitor, I actually spent about 15 years on the asset management side, primarily with an equity focus, both at quantitative and fundamental shop. And I know some of this was covered in the bio that Britt sent around, so I won't belabor it anymore, but really looking forward to collaborating with everybody going forward.
I just want the board to know that I did have lunch with Britt and Kevin, and that was nice. And they did not pay for lunch. So, and we went to 1020, and if I'd known I wasn't going to get a free meal, I would have recommended Shake Shack, but that's the way it goes. But I'm only kidding. But no, it was good. And it was nice to meet. And also Tom was there. So that was very good. I appreciated them coming up and meeting. So
Yep,
I
welcome
missed
aboard.
the email invite to that, Frank. I didn't see that on my calendar.
oh yeah, but wait, by the way, I just want you to know that on your calendar, after the performance review, I will be talking to you gentlemen about my calendar's been pretty busy at City Hall, and we will maybe be doing some things, hopefully as a group. But I'll go on to that after Britt talks about performance review.
Okay, great. Kevin's just going to give a quick update on the markets and the backdrop of the fourth quarter and what we saw in December, and then we'll dive right into performance.
Yeah, thanks, Britt. I'll try to keep this brief so we could keep the meeting moving along. But really, the main themes for the fourth quarter continue to be inflation and monetary policy. And to that end, we saw the Fed double down on its commitment to really try to rein in inflation, even at the expense of economic growth, unfortunately. But they did that by boosting the Fed funds rate by another 125 basis points during the quarter, which means that in 2022, we actually saw 7 rate hikes, ultimately bringing the benchmark rate to 4.5%, which is, I believe, the highest rate we've seen in the last 15 years. On the equity side of things, stocks ended the fourth quarter in the black, but unfortunately, we're nowhere near getting out of the shadows of the broader losses for 2022. Again, primarily those losses driven by a combination of elevated inflation, slowing economic growth, hawkish stance from the central banks, really all of which kind of underscored, concerns around an economic slowdown. In the US for the fourth quarter, we did see the S&P 500 gain 7.6%. And internationally, MSCI EAFE was up 17.3%, and the MSCI ACWI ex-US returned 14.3%. And both of those last two were primarily driven by better than expected earnings and a sell-off in the US dollar. On the fixed income side, I know Frank doesn't love to talk about this, but credit declined alongside stocks with losses of 13% for the Barclays Ag Index. And within that, the hardest hit sector was long duration, with US long treasuries down 29.3% for the year in total. Maybe the last thing I'll just mention is a little update on where we're at so far in 2023. After what was a tumultuous 12 months in 22, it's been pretty much the polar opposite here year to date. Stocks are actually up pretty nicely while interest rates are down on the whole. But maybe to Lawrence's comments in the last session, it hasn't been any less interesting thus far. We're only 8 days into February, and already this month, we've actually seen rates initially drop on expectations for what we might say is a less restrictive Fed, and then to only rise last Friday following what was a pretty historically strong jobs report. So all of which to say is that I would probably agree with him that there's more volatility to come. So I think we just, buckle in and see what happens here, because every day, every week seems to be a slightly different direction at the moment.
Great. Thanks, Kevin.
Thank you, Kevin.
So if we turn to the flash report on page 3 of the PDF, I just wanted to provide an update on some of the ongoing things going on with the pension plan. First, last meeting, we discussed revisiting the asset allocation, and Callan's in the process of conducting an asset allocation analysis to take a look at the portfolio. Our capital market projections this year have changed pretty considerably given where interest rates have gone, and the outlook of fixed income going forward has changed quite significantly. So we're hoping to present that at the March meeting, barring any unforeseen delays. So that's the expectation. The Walter Scott transition is in process. I know Chitsme has been hard at work working with Norwalk's legal and Walter Scott to get that across the finish line. And I think we're at the late stages here and hope to have that completed in the near future. Blackstone made its second distribution from the liquidation in January, totaling about 4.9 million. Those will continue quarterly. We expect the next one to hit in April of a similar amount. The last meeting we discussed taking a look at Northern Trust and the custodian agreement and their fees, and we are in the process of that. We have all of the information from Northern Trust and hope to present that at least on a high level at the next meeting. And then finally, in the DC side, I know this is a pension meeting. I know we discussed Empower presenting at the April meeting, which is the next defined contribution meeting. They are not available, so we're going to have them present in the fall. And instead, we are in the process of doing a target date fund suitability analysis on the capital fund target date funds, which we plan to present in April.
Should we do OPEB in March? Wait if Empower comes in April?
In March, we're hoping to present the asset allocation analysis.
Okay.
So I think that's a big project and certainly something we want to spend time with the board on and make sure that we're comfortable with the target asset allocations and where we're going moving forward.
I mean, OPEB meeting usually consists of about 5 minutes.
Right. I think we are scheduled to have an OPEB meeting in March as well.
Okay. Yeah, our last one was in December.
Yep. So it is March. That is the next one. So moving on to the asset distribution, total assets about $460 $60 million at the end of December. Consistent with past quarters and months, slight underweight to total equity. You can see US equity and international slightly underweight, and private equity slightly overweight. There's also a slight underweight to fixed income and slight overweights to absolute return and real assets. As Kevin mentioned, broadly negative returns in December, but for the fourth quarter as a whole, both equities and fixed income were up. And you can see about 3.1 million in benefit payments going out the door. In terms of performance on page 4, fiscal year to date, LSV continues to perform very well as their deeper value style has certainly come back into favor. You can see their 1-year number up over 10% versus the Russell 2000 value benchmark. So great to see strong performance from them, largely driven by their stock selection in healthcare and information technology. Columbus Circle struggled a bit in 2022. You can see the fiscal year performance is magnified. I think they detracted by just under 300 basis points for the calendar year. And you can see longer term, they continue to be good. Certainly a manager that we'd like to have in 2023 to do a portfolio review as Chris Corbett's taken over the lead, and they had a good year in 2021, but certainly gave some back on the relative side in 2022.
When did he take over?
He took over. Kevin and I were just talking about this morning. Bear with me here.
I think you said it was 2 years ago.
Yeah, I think it was 2 years ago. And the first year, they did obviously very well. You can see that coming through in the latter performance. But 2022, obviously a difficult market environment for growth managers and certainly small cap managers. So we'll have them on our list probably in the fall to come in and do a review.
Yep.
Within international markets, Artisan and Silchester both outperformed for the trailing year. Silchester slightly trailed for the month, but longer term continues to do well. BlackRock, another manager that we'd like to have in probably towards the end of the year, is, they've consistently kind of stayed around the benchmark and have not provided that outperformance that we have been seeking. A lot of that is due to some of their Asia exposure and specifically China that really hurt performance in 2022. We discussed ABS at length, and they did have a strong relative year in 2022. And private equity, most of these numbers are pretty lagged given the monthly report, but we'll have updated numbers next month when the full detailed quarterly performance report is available. Within fixed income, in the rising rate environment, I think MetWest, TCW they have an allocation of the plus sectors, so the riskier sectors out of benchmark. And largely their underperformance over the last year has really been those plus sectors. So, non-agency MBS, mortgages, and underweight to certain parts of the corporate market really hurt their relative performance. And I would say broadly, we've seen core plus managers underperform the ag, just given the risk posture of 2022 and the flight to safety. And the ag is predominantly treasuries, and that was causing the underperformance there. Your absolute return manager, UBS, continues to do extremely well. You can see returning over 6% in a market environment where we saw the ag have its worst year ever, and equities down double digits. So it was good to see their diversification paid off and their differentiated approach provided strong returns. And then PIMCO, your liquid real assets fund, had a positive in the fiscal year, and longer term continues to perform well. I think ultimately some of their risk exposures, such as emerging markets and fixed income and international fixed income, led to their loss over the trailing year. So fiscal year to date, up about 1.9%, outperforming the benchmark. You can see 2022, including the lagged alternatives down about 13%, and longer term, 7 years up over about 6.1%. Any questions on performance?
So you're doing a asset allocation study that
We
we'll
are.
see next month.
Yes.
One thing that I'd like, taking a look at our, question of, do we have enough money in some of these non-equity sectors? So when you look at global equity, long, short, absolute return, and real assets, we're almost up to $100 million. So we're up, 25%. And so I don't know whether if we lump those things together for review, whether, instead of diluting each individual area,
Yeah, I
putting
think
it together would make some sense to see how much risk reduction we get out if we throw those three together in a group rather than in isolation.
Yeah, so global equity, long, short, and absolute return would be bucketed together in more of a general hedge fund category. Real assets is a little bit of a different beast, especially with this PIMCO fund, given, there's under the hood, yes, it is meant to help hedge inflation, but there is equity risk, there is fixed income risk. So that would typically be a separate bucket. But one of the key, I think, things that we want to talk to the board about is, Blackstone's in liquidation. That allocation is going down and going away. And what's the right, stick with ABS, stick with UBS, what's the right allocation to those diversifiers that really makes the portfolio the most efficient? And that's going to be kind of a key dynamic of what we plan to discuss.
Looking forward to it.
Yep. Okay, good.
Perfect.
Great. Thank you.
Anything else, Britt?
That was it. Thank you.
Okay, great. Chitsame, do you need money?
No, I have sufficient fund for this month. We currently have about 8 million in our pension fund in cash, and it's earning at a rate about 4.4%. It's a short-term investment fund. So next month I will bring, kind of our payment schedule for the next quarter. And that's when we'll need a little bit of cash, because I know we still have another quarter of Blackstone redemption that's gonna come in. So I'll get that report for you next month.
Perfect. And I'm glad to hear that we're getting a 4.4% on the money.
Yeah, great.
That's great.
Nicely
okay.
done.
If I have, I've been at City Hall a number of times, and I met with the mayor, and he said that we can go and start to meet in person again.
Oh, good.
Okay. And then I was trying, look at how much more fun I would have had if we weren't on a Zoom call beating up this guy about, I'm only kidding, but, and it may not be, we're trying to make it. One of the things I discussed was that there's a time when, you can go on YouTube, and our meetings go back a couple of years, and you could actually, somebody might be coming in here to give a presentation, and they could go back and listen to, somebody who's some other firm who is looking for the business to be, to review what they said and what the questions were, et cetera, et cetera. So, that was something that I discussed. And also I felt that there were times when, we're talking about 20, 30, 40 million dollars to give people. And and I believe that, first of all, to meet in I've been reading another book about, just body language, the in tone of a person's speech, et cetera, et cetera. I think we can read a lot from that. I mean, I remember once meeting and I don't know whether you guys were there at the time, but when one gentleman started talking, I looked over to Tom when he was there and he just rolled his eyes and went, and it was like, yeah, we're not going there. So hopefully, and now I'm glad that Chitsame is still here because now I have a favor to ask of her. So I also met with personnel and then they said they were not sure about the room that we used to meet in. And so Chitsame is very important in the function of Norwalk. And so I'm going to try to find out if she could get us a room for our next meeting in March, which would be wonderful if we could do that, because some said it was a little difficult to get a room. I did talk to the other thing about whether it's a Zoom or not. I talked to the town clerk about that. I talked to personnel. Now I'm talking to Chitsame. And so anyways, if we can get a room, we can meet in person. And then we could hopefully work it out so that we could not, they were going to check with the lawyers about whether it's legal for us to not have the meeting in, as a Zoom meeting. I don't know what, I don't know that, I know that they recommended it, but I don't know that it's not in the charter or anything like that. So, and I don't know whether, what, this is my opinion. I didn't, poll the other members of the board, whether they still want to be on a Zoom or not. If the other four of you right now were voting members of the board, if you disagree with that, then we could continue on with the Zoom. I went online and, one of the meetings, 50 people saw it and then 100. My big concern is sometimes if we say, I'm concerned. I personally am not on Facebook or anything, and I just don't want at some point for us to say something at a meeting and 5 years from now, somebody says something, and it could be taken out of context. So that's my opinion. But if the other, if Charlie or Eileen or Rich or Jim, you disagree with that, then I won't even try to pursue it. So.
Personally, I'd much rather meet in person.
Yeah,
Right.
I would agree with that. I
And
think
what
your
about-
point, I think your point, Frank, about, other managers picking up competitive information or something they can play on is a relevant one. That concerns me as well.
Anything, Rich?
Yeah, I think going back in person is good, but one consideration is that when we're now down some members. And so I think we should look at the whether we can get some flexibility if someone is out of town, but could call in to make sure there's a quorum.
Yeah.
And so I think that's one of my that's my input on this.
Yeah, having the ability for a board member to dial in would be good. I agree, because we're really tight on approvals many times.
And for a presentation like the asset allocation, we'd like to have someone from our capital markets research group who's really doing all the analysis, join the meeting and to present, whether that's a conference line or Zoom.
Right.
It doesn't matter, but having
I
that
guess-
option is great.
Right. But it's whether, I mean, it's a matter of whether it's recorded if he can come on a Zoom or in a conference call, that's fine, because we've done that in the past. And as far as membership, I have to tell you, I have interviewed a number of people. In fact, it's a little more challenging to find someone than you might realize. And then I did submit a name that, in fact, Joe Kramer's brother, and they didn't, the balance of which political parties people were in became somewhat of a concern. And it was nothing to do with his resume. And I have met with people. And one of the things that I do have another name that I think will be coming onto the board but again, I agree with everyone, and and if any of you have someone you think would be, a good candidate, I'd be happy to hear from you. And I'd be happy to meet with them, just like, with Charlie's been here even longer than I have, but, I think, Jim and Rich, you guys, I sat down and explained what went on, and et cetera, et cetera. And it was good for me. I don't want anybody to come on the board that I know, because I'd rather have people who are a little more independent in their thinking, and that they're not in any way feeling somewhat that they're beholding to me. We never really knew each other much before.
Right.
Do
You
you
guys
only
can-
have friends who agree with you, Frank?
I only have one friend.
You're,
It's my wife.
you're assuming he
That's
has
right, She
friends.
doesn't agree with me most of the time either. But I never wanted to, I've always tried to keep it so that it's not someone to, I don't want to, we always have found a consensus in our votes, which I'm really pleased with. And I wouldn't want ever to have a vote where somebody felt like, well, I'll irritate the chair if I vote against him. That's what I meant, I guess. So anyways, I met with the mayor also when we were in our discussion, not only about meeting in person again, and that's now delegated to Chitsame, I hope. And then also to try to get a candidate that he and I discussed, and that he felt would be fine if they will go on. And then also, I guess I don't know whether this would be a time for maybe Britt and Kevin to leave, because it's going to be that I did meet with also with Ms. Connors, who is the purchasing manager. And so now I'm going to be talking about the procedure for our interviewing possible candidates to be our consultants in the future. Hopefully, it's interesting, by the way, our actuaries did not try to stay with us. We have new actuaries from before, Hooker and that Holcomb. They left. They didn't even apply to stay, and we have a different firm. I was part of that search. Anyways, so I would expect that Callan would submit again. I think that we're all pleased with them, but we do have an obligation of due diligence. I think Callan's been with us since 2009 or so, 2007.
2011.
11. Oh yeah, 11. So they've been here a long time. And by the way, I did at one point, we had a discussion, but as I said, they felt that the last time we renewed without a search. So this time they said, no, we really have to do a search. So,
Yep, not a problem. In fact, we certainly want to participate and enjoy working with you all, and hope to continue that relationship Kevin and I are happy to drop if you'd like to continue the conversation with the board.
Yeah, it might be a little easier, okay?
Sure.
Because I don't want
No
any
problem.
potential conflicts. So we'll see. you
Nice
tomorrow.
to meet you, Kevin.
Thank you. Nice
Yeah.
meeting you.
Thanks, everyone.
luck.
Have a good evening.
Thanks, Brett.
Thank you very much.
Good night.
So the search the contract expires sometime in, I think, around July. And it's Sharon Connors who I met with. And she's very nice. And I have done some other work with her in the past about things. And with the actuary search, for example. So the old contract, I have the draft of the old contract. It's what if we
Hey,
did.
Frank, excuse me for a second. So, yeah, we're talking about Callan. You realize they can hear what you're saying when they go to YouTube tomorrow.
Yeah, well, I told them if they do, that's going to be a point
Okay.
against them. You know, and by the way, so few people go to YouTube, I'll know, I understand that, but anyways, the draft, Sharon would like to have, the last time we did a search was Charlie and I think it was just the two of us, right, Charlie?
Yeah, they were just you and I.
The way the procedure that we had was that they submitted, what the requirements would be, et cetera, what the obligations would be. And then people submitted, and then I think they worked it down to like 5 companies. And then Charlie and I sat in and interviewed with these 5 firms.
Yep.
And then the board met with, I think, a couple, but we did both agree that Callan was who we would like to continue with for the quality of their work and the expense. There were things like some wanted, I'm only kidding, but if you ever see an ad for Fisher Investments, it's like, we do better when you do better. Well, if the market was up 20%, I don't want to, I believe it's best to have somebody who does not benefit by a bull market. That's just dumb luck that they were there at the time. That's my opinion. Anyways, so when I talked to Sharon, she suggested that maybe 3 of us, or even the 4 of us, or Eileen, you would be, if you would want to do this and join us, and I could step aside, or some of us might not want to do this. But I have a copy of the old draft to look it over. And that draft is, but it's 171 pages. Okay. Yeah, I mean.
Why? Why is it 171 pages?
Because they cut it back
proposals
from
or the-
200. No,
Because
this is,
they have lawyers involved.
right. But
The
Well, one of
RFP is 170 pages.
Are the
Yeah.
specs 170 pages? Because I think typically we have a number of boilerplate,
yeah,
documents that we make sure go out on all our bids that are compliant. But typically the spec is only, I think the most the spec should be 5 pages or so at the most.
Yeah.
So we should just probably be looking at the spec.
yeah. I mean,
Thanks for that. That makes me feel a lot better.
yeah, no, really. But honestly, it's even like, the Callan's in here. Look, when we used to get, we get something from them, every 3 months. It's like 200 pages. Okay, whoever reads the whole thing, raise their hand. I do, but that's
Good for
because
you.
that's the downside
Sorry.
of being the
I do.
chair. But anyway,
So Frank, what was
Um,
the time commitment the last time you guys did this?
it wasn't too bad. I mean, I would like to meet with Sharon. And in fact, we had a tentative date, and it ends up that I have a commitment that I can't make it. And it would be sometime, probably, it could be either maybe the 15th of February or the following week. And I think the initial meeting would be very short. And
She's the Norwalk procurement officer?
yes.
Okay.
And so she will send out, she'll send out the information, what the specs are. for us, the last time, when we renewed, I requested 5 years instead of 3. She said they would probably send it out for 3 years with an option for 2 more, mutually agreed upon. So there'll be a few variables, and there might be some things that we want to do differently, slightly differently or not. And like it was mentioned, it can really get down to, reading it over, and I will admit, I did not read the whole thing over yet. I plan to, but there is some boilerplate, and, there's the legalese. And if you think about, some of our objectives, even, we went through all that, and there's a lot more going on there than, than maybe, like Charlie said, who, by the way, who's a lawyer, and he's kind of implied that he's complaining
Retired, thank God.
he's complaining about how lawyers act. He's a lawyer himself, so he knows more firsthand about it, I guess. So anyways, that's something that I will, if send you some of the documents I have. If you could give me a window of, we'd meet probably sometime, morning or afternoon during the week. And I think that would be good. And then if we want to do just maybe contribute some ideas, but then others to interview, I think it would be good if 3 of us interviewed, and I'm fine if Rich, James, and Jim and Charlie do it, or whatever. That's, or Eileen, that's fine. And so anyways, that's kind of like where we are.
Yeah, Frank, if you want to propose some times, let us know, and, send that around, and we can pick what ones work.
Yep.
How many competitors are there in this space anyway? I mean, I only know of 3 or 4 that are national brands.
The last time, I think there were 8 or so.
Okay.
8, I think 8 or 9.
8 or 9, I think.
And
There
who's
were- and then-
who's
We could
researching
eliminate a
those?
few of those pretty quickly.
Yeah, and then we cut out some, I mean, there was one that was literally like maybe the range of cost could have been like, one firm might have been 4 times higher than the other.
Yeah.
So we just kind of, lop them off, and to get it down to say 5, and maybe
Who's identifying those?
who's identifying the firms?
Yeah, the purchasing person, or?
Yes, well, what happens is she sends out, a request, and then
RFPs, yeah.
RFPs, and then people send back,
Okay.
whether they're interested in that. And so that would be how that works. And then again, like if there's a high number, we'd probably cull out, so that we get down to 5 at most.
Yep.
So, and really, I think when we did it, Charlie and I think we did it really in one sitting
Yeah,
almost.
we just one after another.
Yeah.
'Cause it really is easy to get rid of a number of them just on basis of fees. I recall several of them, just like you said, wanted 3 and 4 times as much as Callan was proposing.
Callan was, there was a lot of people competing right at the same
Yeah, I
level
know.
as Callan.
I know,
In case they listen again.
I
Go
know.
ahead.
If I may, I just want to let you know that since the last time you went out for RFP, they have automated some of the programs. So Sharon will put something out through a program called Bonfire and allow people to do this submissions. And then actually anyone who's on the selection panel will get a link so that they can actually review them before meeting. So that might cut down some of the time that you can kind of review them on your own. So that way, when you go to a meeting together, you've at least had a chance to review the submissions and have some idea. And then the team typically will set up criteria for voting, for ranking and things like that. So that's the change that under Sharon's leadership, they've added this kind of automated system that I think makes it a little bit more seamless.
Okay,
Right.
Frank, I'm in. So whenever you're ready for us, let us know.
Yeah, let us know. Put
Okay.
some times out.
All right. So anyways, and Eileen, I don't know if we could see you now, by the way. I hope you know that. And I don't know whether you're interested in doing this or not. I appreciate that you are at the meeting and I think that's important. And anybody else, you know, who wants to, you know, be there, that would be fine too. And, but the person who has the most work to do is Chitsame, because she's got to get us a room so we can meet, you know, you know, and if she doesn't get us a room, the next time she needs money, it might be a little more challenging for her to get it. I'm only kidding. You know,
Somehow I
and this-
doubt that.
And by the way, and this is why I'm not sure that I like that these are recorded, you know? So, you know, if there's anything else, does anybody have any other questions or anything?
Nope.
You know,
I'm good.
and as I said, and if you have anybody you feel would be, you know, a name to submit, you know, to interview them for the board. Twice, you know, once was, you know, it was decided upon not to add the person, and two others that just, you know, was a, you know, I've tried, because I know that to get back to 6 would be a good idea. Although I find the 4 of us to be a pretty efficient operation too, you know, as far as the 4 appointed by the city. So if anybody has any questions, I'll answer them. And if not, if there's a motion to adjourn, that would be wonderful.
Appreciate your efforts, Frank, and a motion to
Yes.
adjourn.
I'll
Second.
second that.
All in favor?
Aye.
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 Excellent. Thank you very much.
All right.
Hey, everyone,
Hey,
take
buddy.
care.
And by the way, thank you for Chitsame to get us a room so we
There
can
you
meet in
go.
person next time.
Yes.
All right. Good night, everybody.
Aye.
Good night.